This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 270, and this week we have a couple of authors and unbelievably experienced people in the finance profession join us. And what prompted it, Ben, was a book that just released actually called The Missing Billionaires, A Guide to Better Financial Decisions. This is written by Victor Haghani and James White. For those who read the book, How Genius Failed, you might recognize that first name. Victor Haghani was a partner at Long-Term Capital Management. But the point of the book is that over the past century, if the wealthiest families had spent a reasonable fraction of their wealth, paid taxes, and invest in the stock market, there would be thousands of billionaires today. But there isn't. There aren't. There's virtually none that came from 100 years ago. And that inspired these guys to write this book as to how can you make better financial decisions. So with that, Ben, why don't you tell a story of how we met Victor and James?
Yeah, sure. That's a good introduction to the book, though. Where did all the billionaires go? And a lot of it's spending policy and sizing decisions on how much risk to take.
Exactly.
In your portfolio. But yeah, so how did we get connected with him? So I knew who Victor was because I'd read When Genius Failed. It's a great book, great story about long-term capital management. So I knew him as this sort of character in that book. And then I was doing research on options for a video idea that I have, and he's got a paper. He's got a paper on whether whether options make sense in the portfolios of retail investors in the Journal of Derivatives, I think.
Yeah.
So I'm reading that paper, and I thought it was kind of cool that Victor had this paper because I knew who he was from the story. And then you and I both got a message from him on LinkedIn, and he's saying that he enjoys our podcast and that he's got this book coming out and he'd love to come on to talk about it. And I'm like, Victor Haghani, is this the same guy that is in When Genius Failed and the same guy whose paper I'm reading right now? And
Who was a partner of Bob Merton.
Right at Long-Term Capital Management. Yeah. So anyway, it was kind of a crazy thing, and it was just a crazy coincidence that I had his paper open when he sent us that message, and then they sent us the advanced copy of the book, and started flipping through it, and on the praise on the cover of the book, you've got a note from John Campbell, Bob Merton. So it was just, I thought I saw Auntie Elvin in there somewhere too.
Yes, he's there.
And then you start Myron Scholes, Michael Mabuse, and just pretty serious people to get praise from. And then start flipping through the content of the book, and it's like, okay, yeah, this is incredible, because what they've done is they've taken pretty hardcore theory, expected utility theory, and packaged it up in a way that, I personally, from reading their book, my understanding of expected utility and how it's useful and why it's important for making good financial decisions is on a whole different level. It's a tough topic. Mm-hmm. It's something that you see it all the time when you're reading papers and stuff like that, but really understanding why it's important and how it can be applied is not so easy. But anyway, so they did a great job with that in the book. But it was pretty obvious, to me at least, once we got a copy of the book and started flipping through it, that it made sense for them to be guests on the podcast.
And we got a couple of questions into Victor about his time at LTCM.
Yeah, and which is just fascinating, right?
Yeah.
And it's yeah. Anyway, so that's the story. And James is no slouch either. Like his academic background is in math from the University of Chicago, but he's worked in finance for I think 20 years. But one of the ones that jumps out at me is that he spent time as a portfolio manager at Citadel.
Yep.
Which is like, I don't know what you'd call that, the MIT of hedge funds or something. I don't know.
Yeah.
Not an easy place to get into. Yeah.
And they both work at Elm Wealth, which is a wealth advisory firm in the U.S. So they're in the business, which is also interesting because they can apply what they're learning to real life situations.
Yeah, definitely. So I mean, I don't know if do we want to give any more background on who they are?
I think we've covered. I mean, Victor's been in the industry for over 40 years. Started at Solomon Brothers in '84, '93 joined Long-Term Capital Management. Had an incredible career in research since then. Co-founded Elm Wealth. James, he pretty much went through it. He's had positions in research, trading, executive roles at Citadel and Bank of America. James is in Philly. Victor's in Wyoming. If you watch the video, you'll see Victor's got the quintessential Wyoming background in the video. But they're really good, interesting, really smart guys. It was a fun conversation.
Yeah, fun conversation. I think it's a worthwhile listen, and we hope people enjoy it. So I think with that, we can go ahead to the episode with Victor Haghani and James White. Victor Haghani and James White, welcome to the Rational Reminder podcast.
Thank you. Great to be here.
All right. So Victor, to start off, based on the title of your book, what is the puzzle of the missing billionaires?
Well, the puzzle of the missing billionaires, which kind of ties back to a TEDx talk that I gave, I don't know, 6 or 7 years ago, is that if we go back and look at the year 1900 and the U.S. census of wealth in America, there were about 4,000 families that had more than $1 million. Now, if those families had been able to invest in a way that more or less matched the return of the stock market, and if they had children at the average rate of other families, then what we would have found is that today, just based on those 4,000 families back then, that we would have, 120,000 billionaire families today that trace back to those 4,000 families. And that even if we make assumptions for spending and taxes, that we still should see thousands of billionaire families today. And if we look at the rich list published by Forbes, we don't really see one family today that traces their wealth back to the year 1900, to those families. And the puzzle is like, how is it possible that not even one family, let alone thousands, weren't able to get that kind of result in terms of investing and spending and distributing wealth down the generations. So that's the puzzle, and it really got us thinking about the different headwinds that individuals and families face in making financial decisions.
Why is the puzzle important to you guys?
Well, as I was starting to say there, that it's just remarkable that we don't have any kind of successful outcomes or even these normal outcomes from all of those families. And it just really highlights how difficult it is to make sound financial decisions over long periods of time. And and that really got us thinking how valuable it would be if we could help people to think about the different errors and missteps that families and individuals make in their financial decision making. So it really helped to spur us to see that there was a really big need for people getting direction on making better financial decisions.
And if I might add, even if you don't particularly value the very long periods of time part in your own investing, given how amazing an investing environment it was, the last 100 years in America, a lot of investing mistakes were made to generate the outcome that happened. And there's just a lot that can be learned, whether you're investing for 1 year or you're investing for the next, 100 years of a family dynasty. A lot of the lessons about what investing mistakes to avoid are the same.
Okay, so I mean, we've talked about in sort of general terms, financial decision making is hard, especially over the long term, and people make investing mistakes. More specifically, what do you think explains the puzzle of the missing billionaires?
Well, look, we face all kinds of headwinds in terms of trying to grow and maintain our wealth. I mean, there's taxes, um, there's the fact that we're spending our money, but we think that those sort of obvious problems, don't really fully explain the puzzle at all. And so, what we think is happening, and as we've taken a closer look at some particular families, we really see this is that over time people make poor risk decisions. So as James was saying, this has been a really, the last 120 years has been a super positive investment environment. So it's not that returns have been really low, it's that people take either too much risk or too little risk at different times with their investment portfolio and also with their consumption or spending decisions. So, these two things go together. We're going to talk more about risk in risk and volatility in your spending decisions and how that could help or hurt your outcomes over time. But on both the investing and the spending side, we think that people weren't making good decisions under uncertainty. And that's really what our book is primarily about, is these how much decisions, these risk decisions. It's much more that than the choosing of your investments.
Can you talk about the features of the common but I think important financial decision-making problems that most people face?
Sure. I think that the most important common feature is uncertainty. That we just don't know we just don't know what the future holds, and building uncertainty into our decisions is really important, and it's kind of subtle. That you don't want to just think about what's the most likely thing to happen, and then make your decision based on that, or make your decision based on a probability of a certain outcome. You want to take account of all the outcomes, and you want to have an objective function. You want to have a benchmark that you're using to translate all these financial decisions into all these financial outcomes into what's important for you to come up with the best decisions under uncertainty. And we'll expand on that more.
What do you think are the most consequential financial errors that people commonly make?
Again, I think that our belief is that they're decisions around risk. And they could be, as I was saying earlier, you could be taking too much risk or too little risk over time. Also, I think that sometimes people kind of believe that you can get return without much risk. And I think that leads people down some very bad paths, that at the center of thinking about investing and your decisions, that you have to really build in that there shouldn't be a way to get more return without taking more risk. And so I think sometimes people will take risk, thinking that they're not taking risk and they're just getting kind of return for free. Another really big error that I think people have a tendency to make is to extrapolate the future from too little past data, sort of what we call return chasing. Thinking that the future is going to be very much like the immediate past, and that this extrapolation error that we are prone to making, I think, is another really harmful one over time.
I would add, and this is something we see and work with clients a lot, in our investment management practice, is people failing to connect their investment policies with their spending policies. And that lack of connection, especially, having not being able to withstand a lot of spending volatility, but having a lot of investment volatility, is what leads to not just once, but sometimes many times for people having to de-risk when markets are on their lows, then they re-risk when they're on their highs. And they ride that, several times. And that can be, really wealth destroying for people. And I think the ultimate cause of that is people not recognizing that their spending and investing policies need to be determined jointly rather than separately.
Yep.
Victor, how do you describe the coin flipping experiment that you documented in a paper in the Journal of Portfolio Management?
That was a really fun experiment that we did, I don't know, maybe 7 years ago. And Rich Dewey was a co-researcher on it with me. We basically presented people that we thought should be pretty financially sophisticated with an opportunity to bet real money on a coin that we programmed, a digital coin that we programmed to land on heads 60% of the time, tails 40%. And they could bet on it. We told them that we programmed the coin to be 60% likely to land on heads. We gave them $25 and a half an hour to keep playing the game, and that we would pay them whatever money they had grown that $25 into at the end of a half an hour, subject to a maximum limit that we would tell them about if they got close to it. And that maximum limit was $250. So we gave them $25. They could just sit there for a half an hour, and we'd give them the $25 at the end of a half an hour, or they could play the game, and however much money they wound up with at the end, we paid them. And that was our experiment. We did that. Yeah.
So you mentioned that the players were financially sophisticated. Who were they?
About 2/3 of them were university students in various finance and mathematical finance programs, mostly graduate students, but some undergrads too. And then a bunch of them, about 1/3 or so, were people working in the financial industry who also had relatively quantitative backgrounds.
So how did they do?
Well, we were pretty surprised that I think 25% of them went bust. And only about 25% of them got close to the cap of $250. And the reason that that's surprising is that just playing the game in a fairly sensible, disciplined way should give you like a 90% or a 95% chance of hitting that $250 cap. But very few people did play the game in a coherent way.
What were they doing that caused them to underperform?
Boy, they were just doing all kinds of things. I mean, one of the most surprising things that they did is that occasionally most of them would bet on tails at different times. They just thought tails was due. Like after 3 heads, it was like, okay, it's going to be tails, and they would bet on tails. They did all kinds of things. Some people just bet $1 every time and never changed their dollar bet. I'm going to just bet $1 each time, and they just did that for a half an hour. Other ones did a doubling down strategy. Some of them just, changed the amount they were betting really dramatically over time. So we saw all kinds of crazy betting strategies, but very little that seemed coherent to us.
So what is the optimal strategy?
Well, the optimal strategy, or the near optimal strategy anyway, we could call it the optimal strategy for these purposes, is some sort of constant fractional betting, where you bet between 10 and 20% of your bankroll on each flip. So you start off, let's say we're going to go with 20%. So the first time you bet $5. If you lose money, then you have $20 left. You bet 20% of that, or $4. If you lose again, you have $16, you bet $3.20, and you just keep betting like that. Or you could do it with 10% or 15%, but just a constant fractional amount you keep betting. If you've made 50, if your bankroll is up to $50 and you're using a 20% fractional betting rule, then you bet $10 on the next one. So just something that's fractional, that's sort of in that zone of 10 to 20% is going to give you a 90+% chance of getting to $250 at the end of the half an hour, assuming that you're betting pretty fast.
Unreal. And so, I mean, these relatively financially sophisticated people, in a lot of cases, failed. What do you think are the main lessons coming out of the experiment for investors?
Well, I think really the main lesson is that that people are not being trained in risk-taking strategies, in the sizing question, right? So these are people, after we did the experiment, we were really sort of puzzled, and we went and we looked at the curricula of various finance program master's degrees at different business schools, and there was no mention of the concepts of how to size your bets when you're faced with a favorable investment opportunity. How big should you be? What should you be trying to maximize? There was no training. So it wasn't surprising that these people didn't really know what to do because they hadn't been trained.
Not only has there been no training, but that what we see both from this experiment and from our day-to-day interactions is that it's not very intuitive to people either. Once you know the answer, it seems really intuitive. But when even we talk to our clients, almost all of whom are finance professionals, and ask them something like, okay, you're happy betting 10% of your bankroll on a 60-40 coin. Now it's an 80-20 coin. How do you want your bet size to change? Some people say lower, some people say higher, some people don't change. It's just you're absent the training. It's not intuitive for most people, even very financially knowledgeable people, what to do.
Yeah, super interesting. And I guess that speaks to the missing billionaire puzzle.
It does. I mean, it shows us that people are not well equipped to think about this how much decision. And as James was saying, the risk of your portfolio is sort of can be compounded by how you treat your spending policy as well.
Okay, so we have this experiment, which is super interesting. But they were betting $25 to start. How is investing real, impactful, meaningful to your future kind of money in financial assets as opposed to a biased coin? How is that different?
Yeah. Well, yeah, I mean, sorry, go ahead, James.
Okay. So we tend to think it's more similar than it's different, but there is one way in which it's really different. Focusing on the $25 for most people, losing $25 or winning $25 is a pretty symmetric outcome and not a very impactful outcome either way. Whereas in investing real money, you can have outcomes that are really impactful on your life, up to and including losing all your money. And as the outcomes become larger relative to your wealth, the asymmetry and impact becomes more evident. So I think almost everybody would agree that whatever your wealth is, going broke versus doubling your wealth are not symmetric. They're radically, radically different outcomes. So that's the big difference between a really narrow experiment like this, where there's just not much money at stake. But if instead you look at, betting multiple coin flips over time and the distribution of results no financial asset, follows a binomial distribution, but the kinds of results you can get relative to your bankroll, even in that very simple thought experiment, are a lot closer to the kinds of results that you see in major financial assets than one might at first think from such a simple setup.
So what should investors be aiming to maximize when they do size their positions in risky assets?
Sorry, let me tell you. Sorry,
Yeah,
James.
ahead,
Let me just start off with one thing. Let me tell you what we haven't touched on it quite yet. There's one thing they should not be trying to maximize, and that is they should not be trying to maximize their expected wealth. That is, I think that a lot of people sort of think that maybe that's what I should be trying to do is maximize my expected wealth. But no, go ahead, James, take it from there.
So, maximizing expected wealth turns out to be not very satisfying because if you want to maximize expected wealth, you would bet all of your wealth on any opportunity with a positive edge. And it really surprises people. People regularly, say to me things like, "Are you sure that's right? How can that be right? Like that can't be right." But if you do the math, you can satisfy yourself that is right, and that even though that strategy has an extraordinarily high chance of losing all your money and a tiny, tiny chance of making a huge amount of money, that is what optimizes your expected wealth. But that's not a strategy anyone would choose to follow. A more sensible strategy, not strictly optimal, depending on individual circumstances, but a more sensible strategy is to maximize median wealth. And as we write about lovingly in the book, we think the full credit answer is to maximize expected utility, contingent on an individual or an agent first having defined and knowing your individual utility function.
Right. And what we mean there, so, to translate maximizing expected utility, we could substitute in maximizing your risk-adjusted wealth or your risk-adjusted return, where the risk adjustment is basically coming out of your utility preferences, is how risk averse you are. So you want to maximize your risk-adjusted wealth or risk-adjusted return, and that is equivalent to maximizing the expected utility of your wealth.
Utility is a tough concept for people to grab, and I do want to come back to that later. So we do have some more questions on that, but I want to move for a minute to the Merton share. Can you talk about how the Merton share for sizing positions in risky assets works?
So conceptually, you can think of it as you want to size positions proportionally to expected returns and inversely to variance. So if for any given kind of opportunity, be it investing in a stock or a coin flip or a bet, in Vegas or whatever it may be, if the expected return doubles, you want to double your bet size. If the volatility doubles, you want your bet size to be cut in 4. And there's a lot of interesting things in there, but one of the more interesting things in there is that nonlinearity between risk and return, that, you want your bet to be inversely quadratic in risk, and linear in expected return.
Yeah, I think it's also a good time to just, say a few words about Bob Merton. That's Bob C. Merton. And the Merton share, the reason we call it the Merton share is from a paper that Bob wrote in 1969. He actually wrote a paper. He was the student of Paul Samuelson at the time, and Samuelson wrote a paper that also had the same finding. Bob wrote his paper and sort of did all the work in continuous time math, and Paul Samuelson wrote sort of the same paper using discrete time analysis. But this 1969 sort of watershed paper that Bob wrote came up with this formula from a pretty advanced, complicated sort of rocket science type of application of mathematics. And in some ways, we're going to talk about it more as we go on. But somehow this 1969 paper, that was a really, really big deal, and it predated Black-Scholes, which used the same technology eventually to come up with its option pricing results. But Bob and Paul's work was like all the rage for quite a while from 1969 onwards, but kind of went quiet, and we'll talk about that more.
And I'll add that what we call the Merton share is really a special case of the result from that paper. Assuming that returns normally distributed and other major standard assumptions.
So I got to ask, and maybe this speaks more to my memory than than anything else. But I don't remember reading about the Merton share. Why is your book the first time I'm seeing this?
So I suspect that even though you've never read about the Merton share specifically, you have actually seen related things. For instance, anybody who's read about the Kelly criteria and are using the Kelly criteria has read about a special case of the Merton share. And, if you look at the form of the Kelly criteria, or you work out how the Merton share works for, a single binomial bet, with the Merton share, assuming log utility, they work out to the same thing. So a lot of people have seen this special case of the Merton share, but probably haven't seen the more general result. And the reason, I think, is the reason why we wrote the book, which is that there hasn't been much, if anything, out there that takes all of this really interesting work from academia, and, but writes about it for a non-academic audience.
I think I remember from reading the book that I'm not alone in that. Like, you've given talks, I think, Victor, to business schools, and not a whole lot of people are familiar with this concept.
Yep, correct.
Huh. So using the Merton share concept, how bullish, this is just a great example from your book, how bullish would an investor need to be to go all in on a bet on Tesla?
Right. That is an example from our book. So we say, well, if Tesla has a standard deviation of outcomes over a year of about 60%, which is roughly how risky it's been, which is kind of says that it's moving around by what is that, by 5% daily standard deviation of the Tesla share price, which for a long time has been that level of volatility. As you get with a lot of stocks that have very, very high PEs. Then for a typical investor with sort of a typical amount of risk aversion, you would have to expect that Tesla's expected return is 72% per year to make having 100% of your wealth in Tesla the optimal thing to do.
Oh.
So you'd have, there were some years where Tesla sort of, got close to those returns, but, for somebody, that's an incredibly bullish viewpoint for somebody to have to justify having that much of their wealth in Tesla. And, we do know, from Twitter and so on, that there are, a fair number of all-in Tesla investors out there. So either they're very, very bullish, they're very, very risk tolerant, or they're, not making a great decision.
Yeah, I mean, I think it speaks to one of the comments you made earlier, Victor, about the people extrapolate from the recent history far into the future.
Yep.
What role does Merton share thinking play in the success of, firms like Renaissance Technologies?
It's hard to say. I mean, we don't know much about what's gone on there. One thing that I would say, though, from reading the Greg Zuckerman book about the story of Rentech and Jim Simon, is that at least in the early days, it seemed that they were not thinking that much about maximizing risk-adjusted return. They seem to be taking an awful lot of risk. And I would almost say that in the early days of Rentech, again, I don't know what the truth of it is, but just based on reading the book, that in the early days of Rentech, they took a lot of risk, and they took a lot of risk with most of their own money. And, I think that the kinds of ideas that we talk about in the book would say that that was, awfully bold, either represented some,
right.
Very strong set of assumptions, or was probably overly bold. Today, now that, the principals are super, super wealthy, and, investing in their medallion fund represents a relatively small fraction of their wealth. Doesn't now I think they've sort of grown themselves out of a dangerous and probably a suboptimal position that they might have been in, 20 years ago or 25 years ago. But, again, that's all kind of speculation. We talk in the book, we talk about, my experience at LTCM, which has some similarities to Rentec. It had a different outcome, has a different outcome than Rentec. But, in those early days, there were some similarities of thinking. And, Rentec sort of grew themselves past that dangerous period of time, and LTCM didn't.
I read that book too. I don't remember the specifics, but I think there were stories in there about very obviously lucky outcomes early on that contributed to the ultimate success.
Yeah, taking a lot of personal risk, and the fund was running a lot of risk. But they figured it out, and they got past it, and they had good, all of the above. I mean, really, really smart guys. I'm certainly not taking anything away from them, but I don't, today, today I think that their main constraint is just how much of the stuff they can do, rather than, risk is just not a constraint for them anymore, it seems.
Interesting. Well, what does the Merton share tell us about asset allocation over time, if it's possible to estimate expected equity returns?
So, as James was saying just earlier, that the Merton share is helping us to realize that when expected returns are higher, we should allocate more to the asset. When risk is higher, we should allocate less. And so, if it is the case that we can estimate the expected return of stocks at different points in time, and estimate the risk of stocks at different points in time, and if those risk and return numbers are changing over time, then it's very likely that we're going to want to change our allocation to equities over time too. When the risk and return is more favorable, we should want to have more invested in equities, and vice versa. Now, it is possible that risk and return could move in exactly a particular way where our asset allocation wouldn't change. But, I think that, most people believe that, that the risk of the equity market is probably, at least over longer horizons, a little bit more stable, and that the expected return is moving around quite a bit. And when I say expected return, what I really mean is expected return in excess of whatever the safe asset is, that I think that's important to get out there. It's not just the expected return of equities, but expected return minus the safe asset expected return.
And how confident do you think investors should be in estimating expected stock returns?
Confident enough to act on it. So again, we're talking about estimating the expected return. We're talking about estimating the center of the distribution. Of course, the outcome is never going to be exactly the expected return. It's going to be above or below that. For each period of time. But we think that using something like the cyclically adjusted earnings yields of equities, is a coarse but sufficiently good measure of expected long-term returns, that we think that investors should be changing their asset allocation based on that, relative to the, as I say, the expected or offered return by the safe asset.
I'd like to caveat that, we think that measures like 1 over CAPE are, sufficiently good measures of expected return, to be useful for broad markets, for things like the S&P, US equities, European equities, things like that. As you go from broad aggregates like that to individual sectors, from individual sectors to single stocks, the quality of the metrics degrade really quickly. So if you ask the question about US equities, I would say, people should be confident enough that it's quite useful. If you ask the question about a single stock, I would say not useful at all.
What about styles? Like values cheap relative to growth right now?
Go ahead, James.
Yeah, so the core logic behind why measures like 1/CAPE do a reasonable job forecasting long-term returns is because at a high enough level of aggregation, earnings look not totally bond-like, but more bond-like than stock-like. This comes back to an observation that Shiller has written extensively about, that stocks have dramatically more volatility than earnings do at a sufficiently high level. And so when you're dealing with large aggregates where, if you look at total corporate earnings in the US and, the history of that over time, there's little squiggles in it, but the squiggles are really little. It looks surprisingly bond-like. And so just like you would for a bond, looking at the earnings you're getting divided by the price you're paying does a pretty good job. As you start going towards aggregates where the earnings look less and less bond-like, that logic holds less and less. So even for individual styles like value stocks or growth stocks, anything where there's really significant regime shifts over time, or where if you look at the earnings and the squiggles aren't kind of de minimis, that's a pretty good suggestion that metric is not going to help very much.
Yeah. Okay.
Yeah. And by the way, when we talk about the squiggles, we're saying, looking at blocks of earnings, like 10-year blocks of earnings, that in quarterly earnings or even annual earnings, they're big squiggles, like you can get. But, looking at cyclically adjusted earnings, they're just not, not bouncing around all that much. That was the Shiller paper, or maybe it was Shiller Campbell, actually.
Yeah. Now, so back to market level dynamic asset allocation. How does that change if we decide that, hey, we actually reject the ability to estimate differences in expected returns over time?
Well, if we reject the ability to estimate expected returns, then in some ways, I think you just can't invest in that asset at all. So that's the first thing, right? I mean, that at a high level, like if you look at the equity market and you just say, I have no idea what the expected return is of equities, then say, well, you really shouldn't be investing there. So you need to estimate it somehow. Now, if your estimate is just going to be, I always believe that equities have a 5% long-term real expected return. Well, if that's your belief that the expected return is always the same, then your asset allocation would change, because we know that the safe asset return is changing over time. So the risk premium would be changing, and you'd want to change your asset allocation. If, however, you said, I believe that equities always are going to give me 5% above the risk-free asset, and that their risk is constant, then your asset allocation wouldn't change over time. But that would be it's better. It's probably better than other things you could do, but it's not great. But if that leads you to just always having 65% of your money in equities, come rain, come shine, come anything, that's better, we think, than not having any money in equities over time. And it's better than being 2 times leveraged in equities over time. But we think that it's, substantially suboptimal. Not just a little bit, but substantially.
I should add for listeners that whenever we talk about risk premium, what we mean by that is the expected return of an asset minus the risk-free rate.
Yeah, so I want to dig more into that. Can you talk about how the real return offered by long-term tips, which, as John Campbell and Cochrane, I think, both explained to us, is the risk-free asset for long-term investors, how does that real expected return affect the optimal risky share in assets for long-term investors?
Go ahead, James. Yeah.
I think it's interesting to think about a thought experiment where, let's say your expected real return for equities was 10%, amazingly good. But in that environment, you could get 10% risk-free from tips, let's say from a 30-year tip or some very, very long-dated tip. So now you have two long dated assets with the same expected return. Equities, let's say they have 20% annual volatility. How much equities would you want in that environment? And in contrast, imagine an environment where the equity real return is much lower. Now, let's say it's 5%. But in the second environment, the real return on tips is zero. Which environment would you want more equities in? We think it's clear that you would want dramatically more equities in the second environment, because one interesting thing about investing that we think doesn't get talked about as much as maybe it should is that all investing is relative. You have to invest your money in something, even if it's in cash. You're really investing in overnight deposits. And so whenever making an investment decision, it almost never makes sense to look at one investment in isolation. You're always investing into something and out of something. And so you have to look at the relative risks and returns. And in theory, you could do that relative to any benchmark asset, but an asset that feels like a risk-free asset to you is kind of the natural baseline to use when comparing to other investments.
How do you forecast volatility for determining the optimal risky share?
So there's lots of observations that we can look to in coming up with that, and in practice, we think that blending some of the different sources of information makes sense. I think realized historical volatility, giving more weight to long-term realized volatility than to short-term is one good input. The options market is a really good input. It's not perfect. There could be risk premium that's also sort of built into the options market, but that's a good metric too. Although, in general, we're making long-term investment decisions, we kind of want to think about longer-term volatility forecasts, and the long-term options market isn't that liquid or transparent to people. But I think, some combination of implied volatility from the options market, historical volatility, and, also just thinking a little bit about a bottoms-up approach to estimating volatility in terms of, well, how volatile are earnings, how volatile are discount rates. I think all of those things together are important. And what's really important also, that it's not just the volatility that's important, but it's the full distribution. And we, in the book, we go into this, that, the Merton share is for this very specific set of assumptions, that are very ideal and non-realistic assumptions. We know that the stock market can gap down, and we know that we can get, a Black Monday in 1987 or in in the 1920s. So, when we're really thinking about the distribution, we really want to also build in probabilities of large tail events, as well. And so, it's important to get a really full distribution and not to assume that, that stocks are this sort of continuously, trading Brownian motion sort of thing, but that, there are real tails, there are fat tails, there are gaps down, all of those things. And we really need to build that into the distribution, and then think about maximizing our risk-adjusted return, based upon that. So it's not just, thinking about the center of the distribution. What we really care about more than anything almost is this small probability of these big tail events. And, this expected utility framework is great for thinking about how much weight to put into those events, and how much that affects your asset allocation.
I do want to get into utility, but real quick, because Canada, we've decided, or the country is phasing out real return bonds. So how would dynamic asset allocation work in a country that doesn't have an equivalent to TIPS in the US?
I think that what you want to do in making your decision is, try to imagine if TIPS existed in Canada or in some market, where would they be trading? And then it's like, okay, unfortunately, we don't have that to invest in. So now my choice is I can invest in in these different assets that have different amount of risk. So let's say I have now equities and I have nominal bonds, but I don't have tips. So I use tips kind of as my numeraire in some ways. And now I have to make a decision between how much I want to put into equities and how much I want to put into these nominal bonds, which are not really that safe, and this framework can easily handle that. We wrote a paper about that, what to do in a world where there is no safe asset. And even tips are not, totally safe, right? I mean, there's default risk, there's tax risk on these things. There's the fact that the index of CPI is not going to be exactly your index. So it's quite nice that you don't need a real investable risk-free asset. You just need sort of a risk-free asset to benchmark everything to, and then decide what's the optimal risk-return portfolio and size for you to have. So you don't need tips to be able to use this, risk-adjusted return framework to do your asset allocation and sizing.
But to maybe give a slightly more concrete answer, I think what most people would do to kind of get that proxy tip yield is look at, the return on long dated nominal bonds that do exist. And then, look at inflation expectations, inflation forecasts, historical inflation, and, take nominal yield, subtract out, some arbitration of, of inflation metrics. And then you get a forecast real yield. That's not as good as having a trading inflation market, but it's probably the best you can do.
Right. All right. So we've touched on this idea of expected utility. Can we just to start this more detailed discussion on that topic? Can you describe the concept of expected utility?
Yeah. So I think it's useful to back up and talk about utility first before we get to expected utility. And my impression is that a lot of people have a bad experience of utility from kind of Econ 101, a long time ago, where it felt like this very abstract, squirrely, unreasonable thing.
Yep.
But we actually think it's something that's really intuitive and that people feel really intuitively. When I talk about it with people, I usually go back to talking about gummy bears. I have this irrational, I don't even have much of a sweet tooth, but I really like gummy bears. And I think most people have had the experience, let's say, you buy a pack of gummy bears and you're eating them, that the last one in the pack is still good, but it's not nearly as good as the first one was. The first one is like really good. And then, by the time you get to the last one, I'm still going to eat it. I'm not going to turn it down. But it's slightly grudging. And, that's that phenomenon is true in almost every thing we consume. Economists would call it, diminishing marginal benefit of consumption. And, I would argue that this isn't an accident. It's not something that's culturally contingent. It's not something that some people feel and others don't. It's a really deep part of normal psychological functioning. Imagine the opposite. Imagine that, for anything we had, like as I eat the gummy bears, the more I eat, the more I want. Controlling your desires would just be impossible. And so this phenomenon that that consumption isn't symmetric, and that there's this diminishing marginal value of consumption is a really innate part of human nature. And utility is really just a recognition of that. And, the utility curve and the shape of the utility curve, something like a logarithm is really just trying to mathematically capture this phenomenon. And in consumption terms, the way it tends to manifest is that more consumption is always better, but it gets less and less better, as you consume more. And then dynamically, the way it tends to manifest is that from a given amount of consumption, losing 10 units of consumption and gaining 10 units of consumption are asymmetric. So losing is worse than winning in its impact on me. And as those amounts get more extreme, the impact gets more, the asymmetry gets more extreme. Going back to, the first example I talked about, no matter what your wealth is, if you compare going broke to doubling your wealth, the monetary and values involved are identical, but the impact really isn't identical. There is a massive difference, I think, for almost everybody, experientially, in going broke versus doubling your wealth. And the utility curve is just recognizing that. And the degree to which that asymmetry exists is different for different people. And so the exact shape and curvature of a utility function is going to be different for different people in different contexts. But the core idea is the same. Now, expected utility. Again, we think this is just a mathematical expression of something that's super intuitive for people. Let's say you have a choice to make, and the outcome of the choice is uncertain. There's two possible outcomes. Well, what are you going to do? In some sense, you're going to intuitively or explicitly make a judgment about what the probabilities are of the different outcomes and what the impact on you is of the different outcomes, and then you're going to weigh them. And that's just what expected utility is doing. It's taking, the probability weighted average of different outcomes, except you're not probability weighting let's say we're talking about financial decisions where there's dollars and cents involved. You're not taking the weighted average of the dollars involved, because, if I look at my going broke versus doubling my wealth, if that was 50-50, well, the weighted average of the dollars is zero. It looks like no big deal. By calculating expected utility, you're taking the weighted average of the impact on you, which is your change in utility, not of the dollars involved. And that's the core insight.
Yeah, it's interesting. It matches up. Everything that you were just saying matches up so well with a lot of the literature from psychology on the relationship between money and happiness, where some research finds there's a plateau in happiness. Some research finds that happiness increases with log income, but it's never, a linear increase of happiness with increasing income.
Yeah, and I think it can't be.
Right.
For people who have that kind of profile, or even worse, a profile where, it's more valuable as you get more, that really verges into what we call addiction.
Yeah.
What is the certainty equivalent return?
So one challenging thing about utility is that expected utility especially is that it's a yardstick, but it doesn't have a very natural sense of scale. So it's really nice to be able to talk about something that has a scale that we're used to dealing with. And, in making financial decisions, return is, the obvious sense of scale, right? So the certain equivalent return is the risk-free return, which delivers the same expected utility as a given risky investment. So I'm considering some risky investment. It has different outcomes with different probabilities. I can figure out its expected utility, but I can also figure out the expected utility of a risk-free investment. And the nice thing about certainty equivalent return is that it says, okay, I have this risky investment. Maybe it has a 20% expected return, but it has a ton of risk. That's equivalent in the utility it will deliver to me of making a 3% risk-free investment. And another word we use for certainty equivalent is risk-adjusted return. And that probably makes the sense of it even clearer, that you can think of the certainty equivalent return as an expected return on the asset with a built-in risk adjustment.
It's kind of, we did this, a survey where we went to people and we said, okay, how much would you imagine that you're not allowed to invest in anything risky ever again for the rest of your life? How much would you need to be paid to forego investing in anything risky for the rest of your life? And so what we found was, so let's say that, how would you go about trying to answer that question? Well, if you sort of have this, if you read our book and have this expected utility framework, it would give you a way to answer it. But people really intuitively come to an answer. They realize that, well, maybe equities are going to give me an extra 4 or 5% return over time, but they're risky. I would be indifferent between being able to invest in equities with this 4 or 5% risky return. I would be indifferent between that and just getting paid an extra 2.5% risk-free. Give me 2.5% risk-free, and that would be about equivalent to 5% risky, sort of scaled down for how much equities I want to own. And when we did this survey, we really found that people were answering the question. Now, these are all sort of, our client base tends to be a lot of financy people, and there's professors in there of finance and all that. So it's not super surprising, but it's just interesting, that when the question is framed like that, you really kind of need an expected utility framework, but at the same time, you don't, because you kind of get the idea. And that risk adjusted return is a pretty cool thing. Like, if you really stop people from investing in equities, you're really taking away something very valuable to them.
Mm-hmm.
Yeah, that's interesting. Can you, it may be obvious from the description that you just gave, but can you talk how you would use the certainty equivalent return to evaluate two alternative investments?
Yeah. So, so I think the full credit answer is find portfolio weights which generate the optimal certain equivalent return. The optimizing certain equivalent return or optimizing risk-adjusted return is basically the same as optimizing expected utility. And so for almost any portfolio question, the most general full credit answer is just find weights that maximize, risk-adjusted return. But heuristically, the nice thing about thinking about risk-adjusted return is that it just lets you, compare assets head to head. So, if I have one asset that has a 5% expected return with 5% volatility, and another that has a 30% expected return, with 100% volatility, I can't just compare their returns. It's not obvious at all how those assets relate to each other in terms of quality on a standalone basis. Whereas if I had two assets, one has a higher risk-adjusted return, if I'm going to do A or B, I'm going to do the one with the higher risk-adjusted return. That's a higher quality investment at that size. Or another kind of interesting way to think about it is that if you look at a given investment at a given size and its risk-adjusted return is lower than the risk-free rate, you have too much of it. Do less of it. If it has a positive expected return, you'll want to do some of it. Anything with a positive expected return in isolation, you should want some of. But if at a given size, its risk-adjusted return is lower than the risk-free rate, you have too much.
How does the certainty equivalent return deal with skewed expected return distributions?
Yeah, so the nice thing about the whole expected utility risk-adjusted return framework is that it's not making any built-in assumptions about the nature of the return distribution. So your utility function is intrinsically skewed in that, for the same magnitude, negative outcomes hurt more than positive outcomes help. And then when you compute expected utility, you're just taking probabilities and outcomes. So the machinery of it can really deal with any kind of distribution, be it normally distribution, heavily skewed, kurtotic, whatever. The outcome you see is that for normal shapes of utility, if you fix the expected return and you fix the Sharpe ratio, the framework will naturally prefer positively skewed to negatively skewed distributions, which is to say, if all the other characteristics are the same expected returns, the same variance, you would prefer a skewness where there's a high chance of losing a small amount of money and a small chance of making a lot, to a negatively skewed investment where there's a high chance of making a little bit, but a small chance of losing a bundle.
Okay, interesting. So if we take the certainty equivalent return and the Sharpe ratio, and we're using them to evaluate something like covered calls or something else with an asymmetric return profile, what's the main difference in our decision going to be?
Yeah, so Sharpe ratio really breaks down as you start looking at heavily asymmetric payoffs. For instance, I can construct a portfolio or an investment that has normally distributed returns, and a given Sharpe ratio, or I can construct I can get the same Sharpe ratio with a heavily asymmetric payoff. And so the Sharpe ratio doesn't really tell you anything about that. It's not useful in distinguishing between those two. But what the utility framework tells us is that people with utility-like preferences should distinguish between those two. You should really prefer, let's say, normally distributed to negatively skewed, and you should prefer positively skewed to negatively skewed payoffs. And so using expected utility or risk-adjusted return will naturally deal with that, whereas Sharpe ratio won't. And one of the famous papers that kind of talks about this with respect to Sharpe ratio is the Gertzman-Ingersoll paper, Sharpening Sharpe Ratios, where they basically show that various option combinations can really be used to manufacture Sharpe ratios for people who are only sensitive to Sharpe ratio and don't care about other qualities of the return distribution.
Let me just mention that we have a whole chapter in the book on the use of options within the expected utility framework, and it's a little bit I think we give options a bit of a hard time, and this is actually the 50th anniversary right now of the Black-Scholes model, and two of our friends and partners are well, the Black-Scholes Merton, we could call it. Two of the three initials are friends, and I'm going to see them soon. I'm kind of hoping they haven't read that chapter, although Myron has read the chapter and objected somewhat. But in general, we kind of feel like these options, that options are not super useful for individual investors in general, or there's a hurdle there. We decided to put this chapter in the book, because we felt that there's a ton of books out there that are about trading options to get rich, but there's not anything that we could find out there that really addressed options within the context of individual personal finance and investing. And even great books like Jack Bogle's books or others don't even address options at all. Like in Common Sense Investing, there's no mention of options, or in Charlie Ellis's book or whatever, or even William Bernstein, authors that we like a lot, they just don't really get to talking about options. So we thought it would be useful to bring them in there and talk about them within this risk-adjusted world. The other thing I just want to add briefly here also is, like, all of the expected utility that we're talking about, we're talking about it with one particular utility function, what we call constant relative risk aversion utility. We like that utility function. There are other utility functions that people could have, other shapes, other preferences, but just for background, we're sort of making a lot of our statements, based on that sort of function and shape, but again, we think it's a good one. And we also think in most other plausible ones, you get the same sorts of results out as long as you have this diminishing marginal benefit of more wealth or more consumption that James talked about.
I'll also add that this question about skew distributions arguably is the question that ultimately resulted in our writing this book, because the first note Victor and I ever wrote together back in January of 2017 was called A Sharper Lens for Sizing Up Nickels and Steamrollers. And it was exactly about the differing perspective you get between Sharpe ratio and a utility analysis and looking at investments that have a lot of tail risk.
Yeah, it's incredible. I'm glad you brought that section of the book up. So I'm going to ask a little bit more about it now, Victor, because I actually, when you sent Cameron and I a message on LinkedIn, it was the craziest thing, because I knew you as sort of a character from a book that I'd read, right, about LTCM. And then I had your paper open on whether options make sense in the portfolios of retail investors. So I'm sitting there reading your paper, and I get a message from you on LinkedIn. Anyway, it was crazy. So I'm going to ask about that a little bit more explicitly. You touched on it a little bit. Do you think that options generally make sense in the portfolios of retail investors?
Yeah, I think that the answer to that is no. For a yes and no answer, could make sense sometimes, but generally speaking, no. James and I, don't use options in our personal investing. We don't think it's a great fit, for most individual investors under most circumstances.
Okay. Well, we started talking about
we're talking here about options on financial assets like home insurance, right? Is kind of an option. Home insurance, against fire or whatever. Some of that can make sense. Sometimes it doesn't. I don't actually carry home insurance, but don't tell my wife. But for most people, home insurance is going to make sense, and that's a form of an option. But in general, we think that for individual investors, that options don't make sense in general. Not always, but in general.
Right. Yeah. That's a great paper, and I think that the section of your book on that is similar to the paper, right?
Yes. Yeah. It's based on that. Yeah. The Journal of Portfolio Management or the Journal of Derivatives let us base that chapter on that.
Nice. Okay. Okay. So when we started talking about utility, James, you kind of mentioned that people might not remember it so fondly, and I think it does get criticized sometimes. How do we know that expected utility as a framework is actually a good model for normative personal finance recommendations when so many people don't behave the way that the model predicts?
Yeah, so I think it's worth distinguishing behavior and preferences. A lot of and also between important and non-important situations. A lot of the experimental evidence violating people optimizing expected utility is really in like very small dollar situations, where the relevant asymmetry is just not as big. And but more importantly, I think I want to distinguish between people's preferences violating expected utility and people's behavior violating it. As investment advisors, as researchers working with our friends and clients and other people, our overwhelming experience is that when we really focus on people's preferences, reasonable utility functions do a pretty good job representing people's preferences. And again, I think that's not an accident. That's really innate. That comes down to the fact that human nature would look totally different if we didn't experience some kind of diminishing marginal benefit of consumption. And so, one of the first things we say in the book is, this book is meant to be normative, not descriptive. What we're trying to do is help people behave better in line with their preferences, not just, reinforce the, the behavior they have. And I think seeing that gap between preferences and behavior, it shouldn't be so surprising, because the real world is so complicated. There's taxes, there's longevity uncertainty, there's returns uncertainty, there's so many different outcomes that intuitively mapping your preferences onto a consistent set of choices, given all the choices we have to make, is really difficult. And, there may be some people out there who are just intuitively amazing at that. Warren Buffett, like, I don't think he has an expected utility framework, but he seems really naturally good at incorporating the same kinds of information that a utility framework would, risk and return, and, the asymmetry of benefits and things like that. Most people aren't that naturally good at it. And so, I would be, if I thought that there were a lot of people whose underlying preferences were really different from utility assumptions, I would be more worried. But that is not our experience at all.
Yeah, that's really interesting. Again, in the psychology literature, there's lots of, like, I talked about how when you actually look at whether money makes people happier, there are diminishing returns. But then there's also research showing that people predict that more money will make them a lot happier, even though that's not actually the case. So I think that kind of speaks to what you're talking about.
So why hasn't this framework caught on more widely?
We think there are a few reasons, in different domains. If you look at Wall Street, for example, I think the big reason is that Black-Scholes came along. This kind of work was really hot. People were really interested in it. And then, there was the derivatives pricing revolution. And a lot of the people who had the mathematical and technical backgrounds to read Merton and Samuelson and, read this kind of literature, just went into derivatives pricing and your risk neutral valuation, and just the whole risk neutral world kind of took over everything. Outside of Wall Street, I would say I feel confident that the reason it hasn't caught on is not due to lack of utility, no pun intended. When and one piece of evidence I have for that is that if you look at a group of people who is the most dedicated to making consistently good financial decisions, successful professional gamblers. Successful professional gamblers overwhelmingly use variants of the Kelly criterion, utility-based decision-making, decision-making that integrates risk and return in some consistent way. I think the experience of professional gamblers who don't is that they don't remain professional gamblers for very long. Is for why it hasn't penetrated the broader investing world more widely. I think that's a big part of why we wrote the book. For something to penetrate widely, you really need not just great but really, really heavy technical papers. You need a broader conversation for a broader audience, and that's really what we hope our book to be.
It really is incredible. Like, it's I agree with you, but we did an episode on covered calls a while ago. That's why I asked about that, and that's a topic where it's like they get evaluated with Sharpe ratios, and you get people selling ETFs or mutual funds going around showing how high the Sharpe ratios are, with no mention of expected utility. So I totally agree with you that it's something that people need to understand better. And I think you guys have done a great job in the book doing that.
Thank you.
I think maybe another reason is that like we talked about up front, that there's just a lot of people who have this bad experience with dealing with utility, from taking Econ 101, or conflate this kind of utility-based decision making with Benthamite utilitarianism. And have this feeling that have from Econ 101, try to apply utility to non-financial things, where it becomes much squirrelier, and just have this this kind of gut reaction that, like, oh, this stuff isn't very useful, but our experience that when we really take people, regardless of their priors, when we really take people through this framework and its assumptions, people actually find it really natural and intuitive.
All right. So Victor, I mentioned that I knew you prior to this as a character in the book When Genius Failed. So I got to ask, how did your experience, because I know the story from, the author's perspective, but not yours. How did your experience with LTCM affect you professionally and personally?
Well, I mean, first of all, it was very, very painful. I mean, I can sort of smile about it now, 25 years later, but it was painful. It was embarrassing. It was, I mean, it just, it really hurt. I think that I'm incredibly grateful that as a group of partners, we sort of had each other and maintained our friendships till today, throughout, and that helped it somewhat. But it was just really, really painful. But over time, as I don't know if you guys have read the book by Dan Gilbert, Stumbling on Happiness, as he and others in this sort of happiness field point out, that, over time, no matter how bad a thing happens to us, we kind of drift back to our normal state of happiness. And, that took a little while, but, I think I eventually got there. Professionally, it marked a change in direction for me, where, I kind of wanted to take time to understand what had happened, to learn from it. And I stopped, I didn't want to, I stopped, in that field. And, I kind of feel a little bit fortunate because, in 2007 and 8, this, a bigger storm came through the markets, and I feel good that I didn't sort of devote those interim years to going back to the coalface of relative value trading. So, I think it gave me a good feel for the range of my utility function, you could say.
How did you decide how much of your wealth to invest in LTCM?
Well, and we have a chapter on this in the book, how really the chapter is about my own personal perspective and experience. It's not about, trying to rewrite or set the record straight or anything on LTCM. It's just about how I, experienced it and dealt with it and thought about it. And, by the time we started LTCM, we had this long track record of doing relative value trading that went well beyond my time, going back into the late 70s with John Merriweather and his and the earlier people in the group. It was just this, seemed like this highly profitable, high Sharpe ratio type of activity, with a really good sense of where the money was coming from. It wasn't like a black box sort of thing at all, and we had a lot of market experience. We really thought about what was causing things to be out of line and what would be catalyst to bring them back. We didn't just look at valuations. We didn't just use models. We used a lot of experience looking at things. And, it was just it looked very attractive. So as a partner of LTCM, my approach to begin with was to say, well, I'm going to just take a certain amount of money that I'm going to be happy with. If I lose everything else, what's an amount of money that I'll just be happy with, having in safe assets on the side. And I put some money aside, and then with the rest of my money, I put it into the fund. And, I would say, I don't remember exactly, but I would say that probably, 80% or so of my liquid financial net worth, I had invested in LTCM one way or the other. And, as we discuss in the chapter in the book, I think in hindsight and without knowing what the outcome turned out to be, I mean, with perfect hindsight, I wouldn't have invested anything. I would have invested and then taken it out at the end of 1997. But, I think that there's a reasonable case to be made on an ex-ante basis that using an expected utility framework, I would have reached a different decision, and that, other people can sort of benefit from those, experiences and mistakes, now. So.
Yeah. I mean, super interesting to hear you talk about it, and I'm sure that our listeners will find the same thing, because that's not an everyday event to have lived through, as of course you know.
No, it wasn't. Learned a lot from it. It's actually also, roughly the 25th anniversary. I think, some people would say, I don't know, September 12th or something like that, 1998. So a couple more weeks and it'll be, exactly 25 years. The fact that the book is coming out now is a coincidence. The book is not about LTCM, even though the experiences of LTCM certainly have shaped, and James had his own sort of mini LTCM sort of experiences too.
All right. So we spent the last little while talking about sizing positions in risky assets and the expected utility framework. I want to move on to spending, which you also cover in the book. What do optimal solutions for lifetime spending from a portfolio look like?
So there's two characteristics that I really want to focus on. The first is that spending should be proportional to wealth. This is probably the most important one. And, obviously, nobody is going to follow a spending policy that, every day is literally proportional to wealth. But in some big picture, with a lag or with some averaging or whatever, for a spending policy to be close to optimal, it has to be proportional to wealth. And, that falls out of the math, but I think it's also pretty intuitive. If you're spending any policy, if you have any spending policy that's not, your wealth drops a lot, your spending doesn't change, you're going to run out of money pretty quickly. So in some big, or the other way, if your wealth increases a lot and your spending doesn't change, then you're just massively underutilizing your wealth. So the most important character is that spending should be proportional to wealth. The proportion can change over time, depending on your other preferences. It might be optimal for you to increase the proportion over time, decrease it over time. But in any given time, it should be proportional to wealth. This creates a really interesting relationship, which is that imagine you're following it perfectly, and your spending is perfectly proportional. Well, then the volatility of your spending is going to equal the volatility of your investment portfolio. And that connection is both a major constraint and also really useful in helping figure things out. That's what creates the necessity to not kind of think about your spending and your investing separately, which is in practice what we see often happens, but to set your spending and investing policies jointly. Because if you have to be proportional to follow even a reasonable spending policy, and, let's say you can tolerate 10% of spending volatility, but then you go invest in a portfolio with 30% volatility, you're going to have a huge problem.
Yep. How did Merton and Samuelson solve the lifetime investing and spending problem?
So their solution, they solved it differently. In both cases, their solutions were really interesting and innovative. But I actually think this is a case in which the bigger part of the genius was in posing the question rather than the specific way in which they solved it. And, the way they posed it was every period, say every year, I have two questions to ask and answer. how much should I spend, and how much risk should I take? Specifically, how much, I have some risky portfolio and I have a risky asset. How much should I invest in the risky portfolio versus the risky asset? And how much should I spend? I have that same question every year. What is the joint spending investing policy that maximizes my lifetime utility of consumption? That was their setup. And that setup really unlocked a huge amount of interesting results. Now, in some cases, with a lot of starting assumptions, you can get to analytic solutions for that, which Merton showed. These days, we tend to solve that system numerically rather than analytically because we want to include a lot of real-world hair, like taxes, longevity uncertainty. There's a lot of real-world situations that make the analytic solution unworkable. The analytic solution still gives us a lot of intuition about the character of what's going on. But I really think the number one innovation was just posing the problem like that. And, one of the first things I talk about with clients now is that I still think the two most important questions clients should focus on are how much to spend as your wealth changes and how much risk to take. And, a lot of people, even highly financially sophisticated people, almost never explicitly think about how much total risk am I taking? They think about individual investments, how much they have in individual stock or individual portfolios, but it's rare to encounter somebody who has explicitly framed the question for themselves as, this year and next year, and, how much risk should I be taking?
What are the inputs? If we're talking about optimizing lifetime spending and asset allocation, what are the inputs that people should be thinking about?
Yeah. So in a really highly stylized world, the major inputs are your personal risk aversion, your personal time preference, which is basically the discount rate you apply to your utility of spending over time, the characteristics of the risky portfolio, so in a highly, highly stylized world, the expected return volatility of the risky portfolio. In a less stylized world, just the distribution of returns of the risky portfolio and the risk-free rate. And then if I add, a little bit more real-world context, I would add to those your age, your longevity distribution, the priority you place on bequesting wealth versus consuming wealth. Or another way to think about that is your utility of bequest separate from your utility of personal consumption. Your subsistence spending, meaning for most people, they get to a really, really, really bad place before spending literally goes to zero.
Right.
And, for most people, there's what economists call subsistence level of spending, at which that's basically as bad as it can get. If I'm not personally, but, let's say I'm spending $1 million a year and my spending drops to $10,000 a year. Well, there's really no difference between 10,000 and zero,
right,
at that point. So identifying, subsistence spending, tax rates, not just the absolute rates, but the structure of taxes. Those are all things that are inputs to our process and inputs to a less stylized process that that involves a lot of real world things.
So you've presumably got this in a model. Can you talk us through the mechanics of how you would use this framework with like a client, for example?
Yeah. So we start off by sending them a lot of questions. And some of the questions have factual answers. What is your net worth? Things like that. And some of the questions are less factual, like how do you think about the value of spending on yourself versus, leaving money to your family, to philanthropies, things like that. So first, we collect a lot of information from them, and that has, personal factors, their age, their wealth. It has questions related to calibrating their utility functions. We don't treat those as kind of final answers, but I think of it more as the calibration questions give me a starting guess, as to how risk averse somebody is. And by risk averse, what I really mean is how much curvature is there in their utility function. And the calibration questions also give me a sense of what is there that's consistent or inconsistent, in how they're thinking about. Sometimes people answer calibration questions very consistently, and sometimes they answer them quite inconsistently, and then you have to drill down into that, and understand where that comes from. So all of the answers are kind of starting guess. We take all of those, we put them into a big optimizer we have, which simulates a risky portfolio. It has taxes. It knows about the actuarial tables, so it has stochastic longevity built into it. And then we apply, what I call the general method, which is optimize utility of consumption over, utility of consumption over time. We find the spending rule and the risk rule that maximizes their lifetime utility of consumption. We have to do that numerically by simulation rather than analytically. And then what we show people is basically what those policies look like, both in terms of, spend 4% this year, 4.5% next year, 5% next year, whatever. And also the heat map of, if you follow these optimal policies, what is the probability at a given year of your spending falling below a given level and your wealth falling below a given level? And then we talk about it with people. And then there's this kind of iterative process where between the answers people gave and these heat maps that they're looking at, we see how comfortable they look. And, sometimes we get it really close the first try. And sometimes, people answer in a certain way, and then we look at the heat maps and they're like, oh, no. This shows a 30% chance of my spending falling below X 5 years from now. I can't tolerate that. That's absolutely intolerable to me. And, that means that they're probably more risky. They're either more risk averse than we originally thought, or that their current spending is just too high relative to their wealth. And, which is which will depend on the individual person and their individual situation. And, we just drill into it until we feel like we understand what's going on. But we really use the starting questionnaires and these heat maps arising from the optimal policies iteratively to ultimately get to both a risk of, a set of utility and bequesting risk aversions that feel comfortable for somebody, and a set of policies that, both investing policies and spending policies, that feel comfortable for somebody. And I should say, not just comfortable. It's really important to me to have policies for clients that are comfortable, because if it's uncomfortable, you just know people won't follow it.
Yeah, right.
But it's also important not to have policies that are where you only think about comfort but ignore like how suboptimal is this is. There can be a policy that's comfortable for somebody, but it's just massively suboptimal too, and that's not good either. Where one of the places where the utility framework comes in is helping people find policies which are jointly followable and comfortable, and I won't say strictly optimal, but in the vicinity of optimality. And one of the really nice things about the whole utility framework is that if you boil everything down to one dimension, and you look at, let's say, expected utility or risk-adjusted return as a function of your one dimension of how much risk you're going to take, say, it's going to look more or less like a parabola. And in the vicinity of optimality, the slope is not going to be very great. So being really far away from, the optimal is not good. But because the slope is just pretty shallow in the neighborhood of optimality, it's not important to get bang on. It's important to be in the right ballpark.
So why don't we see Merton-Samuelson spending built into typical financial planning softwares?
We don't know what everybody does, but I think the answer is similar to the answer to why you don't see the Merton share around a lot, which is that it just hasn't been written about in the mainstream very much yet. And what any investment advisor who's trying to appeal to a lot of people wants to do is, or I shouldn't say any, but most is take advantage of concepts that are already out there. So that's probably a long-winded way of saying a much more glib answer, which is people haven't read our book yet. Which I say that tongue in cheek, but I think the generalized version of that is just that these concepts are only starting to move from academia to the mainstream, and as you see it enter the mainstream more, it would really surprise us if people don't move in these directions.
Right.
So you mentioned a questionnaire that you use with clients to kind of work toward figuring out their utility function and their risk aversion and all that kind of stuff. How can a listener who's maybe managing their own money or maybe working with an advisor, how can they figure out their utility function and their risk aversion and their time preference?
So there's a lot of calibrating questions you can ask yourself. And I would say there's really formally 3 domains for thinking about utility. There's utility of wealth, utility of spending, and utility of bequesting. And bequeathing, I think, is maybe the right way to say it. And in some situations, utility of wealth and utility of spending are really combined. So the Merton-Samuelson framework, really combines them, where if you're following a proportional spending rule, utility of wealth and spending are really combined in there. Whereas, let's say it's a context where you're not thinking about spending at all, like you're running a fund, or you're a gambler and you're trying to, make bet sizing decisions. You would think about utility of bankroll rather than utility of spending. But, there's these calibration questions you can answer in any of those cases. And all of them have roughly the same form, which is, how would I feel about, for example, a 50-50 chance of losing 10% of my wealth versus making 10% of my wealth? Would I want to take that opportunity? Would I reject that? Or would I be indifferent to it? And by finding where you're indifferent, if you limit yourself to CRRA utility, then you can calibrate your utility by finding that indifference point. And there's a lot of ways you can ask that question. My personal favorite way of asking it let's say with respect to wealth, is let's say there's an opportunity where there's a 50% chance of losing X percent of wealth and a 50% chance that you'll become a multi-trillionaire. What is the highest X for which you would not take that bet? So clearly 50-50 chance, 5% versus a trillionaire, I would take it. 50-50 chance of, losing half of your wealth versus becoming a trillionaire. It's a much harder question now. Your answer maps 1-to-1 onto, your level of CRA risk aversion. And I should add that we talk about this in greater detail in the book, but one thing we feel pretty good about is that for most people, institutions, and circumstances, CRA risk aversion is flexible enough. It's certainly not, doesn't capture all the nuances of utility in most circumstances. But in our experience, for most people in situations, it's flexible enough, and it's not necessary to move beyond that. The academic literature explores tons of different classes of utility functions and can get all kinds of bizarre results, depending upon how bizarre your utility function looks. But in the real world with real people, we think CRA utility really does a very good job. And you'll see that variously called CRA utility, isoelastic utility, power utility. They're all really the same thing. And maybe I'll also add that even though there are different contexts where you might want to think about utility of wealth, utility of spending, utility of bequesting, when working with clients, I usually start off with utility of spending. And the reason is, I think for most people at most levels of wealth, spending is really where the rubber meets the road. People have a lot of experience, real personal experience, dealing with what it's like having to cut their spending by 10%.
Yep.
What it's like having 10% more to spend. They really have lived experience and strong preferences about that. As you move away, the questions become somewhat more abstract. And so I like to start with spending. Now for some people, with extraordinarily wealthy people, whose spending is like a tiny fraction of their potential spending is less of a constraint. And so you tend to focus on wealth more. But for most people, I feel like the thing that constrains their risk aversion more than anything is the volatility of spending they're willing to tolerate, and that people really give different answers sometimes when asked about spending versus wealth. And my experience is when you dig into that, the spending answer is almost always the one reflective of true preferences. Sometimes you encounter people who, for example, express a desire to have very, very low volatility of spending. But then when you ask the same questions about wealth, look like tolerant to very, very high levels of wealth, of wealth volatility. And, if you dig into that and kind of walk people through the consequences of that, let's say the consequences of having a very volatile investment portfolio while following a very tight spending policy, I would say in almost all circumstances, the result is that isn't that people say, oh, no, I was wrong. I could really tolerate a lot of spending volatility. That's almost never the case. People usually say, oh, yeah, I wasn't really thinking about the connection. I'm really not so tolerant to wealth volatility either.
Here's a question for both of you. What advice do you have for young people as they start out their financial journeys?
I think, I don't know, I'm going to say three. I'm going to say I have three pieces of advice, but as I say them, I might come up with some more. I think the first one is that you're young, your human capital is very large relative to your financial capital for most people. And you should give that a lot of focus. You should really focus on, what you want to do, with your life in terms of work and career and all of that. And, expected, sort of thinking about risk adjusted, the risk adjusted value of your human capital is a good way to think about it. The different careers are going to appeal to you inherently in different ways, but also you should take account of the riskiness of different kinds of careers and make some adjustments for that, as well. So I think a big focus on human capital would be number one. Number two, I think, would be make sure you're starting your financial education. Work some books into your routine. You don't want to spend all your time reading finance books. They could be pretty boring, but make sure that you're getting a financial education by that time, if you haven't had it already, and talk to people and think about it and try to really get yourself educated. And then the third thing is start to develop some good habits. Even though sort of the academics would say, well, you want smooth consumption, so maybe you should borrow money when you're young and then save more as you get older. We would say, like, develop some good habits. Start doing some saving, put it, especially tax deferred saving, and start thinking about investing. We would say, invest in low cost, broadly diversified index funds. That's what we would say. But do your research, do your financial education, and
Right.
and hopefully you'll get to that too. So I think those would be the 3 bits of advice.
Yeah, I think that was really well stated. I mean, the only thing I would add is that people should really read our book too.
It is a really good book. It's for the average person off the street, it's still pretty intense in terms of in terms of the level, but it's a whole lot better than trying to read one of Merton's papers. Now you guys both have experience in academic settings, and you've seen some pretty wild stuff in practice. And we talked about LTCM, Victor and James. It sounds like you've had a smaller but similar experience. What's the most important piece of wisdom in investing, financial wisdom, that you can leave our audience with?
Well, I'll take a crack at that first. I mean, I think if there's just one sort of golden rule of finance or investing, it would be what I said earlier on, which is that you can't expect higher returns without taking more risk. That return and risk are bound together. This is kind of related to the theme of the book also, in terms, that we bind them together using this expected utility framework. But the fact that you can't expect higher returns without taking more risk doesn't mean that you can't get more risk without getting more return. It's easy to get risk without getting return. You can go to Vegas and you can get negative return for risk. So there's an important corollary there, which you shouldn't expect higher returns for risks that you can eliminate through diversification. And it's just like, I think that if you get this into your head, that you can't expect higher returns without taking more risk, and that this is like enforced by the competitiveness and efficiency of markets. I mean, everybody's looking for more return without risk. It's the proverbial free lunch, and that's what makes it so difficult to find. So I think if people get a respect for the efficiency and competitiveness of markets, and that you can't get higher returns without more risk, that's going to be a great guide to your financial ship through your life.
And I agree with all that. And, maybe one thing I would add is, I would advise people to spend as much time thinking about the how much to invest question as they spend on the what to invest in question.
Mm-hmm.
And, I think that goes for professional investors, whether you're at a bank or a hedge fund, or individual investors. For social reasons, for a variety of reasons, almost all the focus is on what do I invest in? And, the reality is that you're going to make a lot of investment decisions over your life. Not all of them are going to be good. And if you have a good way, a robust way of thinking about how to size those investments, how to take the right amount of risk, you'll be able to survive through, and better than survive through all of the bad decisions you make. And, it's just not plausible to think that you're not going to make a lot of bad decisions over a sufficiently long period of time in terms of what to invest in. That's really, I think that's really the key to making investing, both livable and much less stressful over time, and something that is really neglected in books, in the literature, and in people's own time space.
I love both those comments, and I think that they go together really nicely because, as we talked about earlier, even somebody with a good framework might invest all of their wealth in Tesla if they believe that there's a 76% expected return. But if they understand how risk is priced and how markets work, then they might revise downward their expectations.
Our final question for both of you: how do you define success in your lives?
Go ahead, James.
Start? Okay. So the full credit answer, is I think, for me at least, still a work in progress for sure, as it is for most people, I think. But one aspect of it for me, I was exposed early to the famous Carl Sandburg quote: "Time is the coin of your life. It is the only coin you have, and only you can determine how to spend it. Be careful lest others, try to spend it for you." And, certainly when, at the end of every year, when I go back and look at the previous year and, kind of think about the scorecard, this isn't the only thing on it, but did I use my time wisely is a really big part of it.
Right.
And, I say that without any judgment about what use of time is worthwhile, for any person. I think there's a lot of variation across individuals and even within individuals. What I find worthwhile spending my time on is very different now than it was 20 years ago. But, the wonky economic perspective is that, time is maybe the ultimate scarce resource. And I feel really strongly when I don't use it well, that was not successful, and when I do, that it was.
Okay. Yeah. I mean, I like that, James. That was great. Great to hear that. For me, I guess, as thinking about this, I feel like I just have had so much good luck in my life in different ways, and good luck that has been delivered by different people. My parents were great. Well, my mom's still alive. My parents have been great. My family, and the people that have come along in my journey and have helped me and given me chances and educated me and protected me and all of that. Like, I just feel so fortunate, not only being born at a great time, into the history of the earth or the history of humanity, but also I feel super fortunate in terms of what people have done for me in my life. And so, I think that I'll define a successful life as one where my deficit of what I've done for other people versus what I've been given is as small as possible, maybe even positive. I think that's, at the end, if there's one thing, I think that's what I would like to measure it by. And I'm still in quite a big deficit. So I'll see how things go. I'm getting older.
Wow. Yeah. Great answers from both of you guys. This has been a fantastic conversation. We really appreciate you coming on the podcast.
Thank you.
Yeah. Great to meet you both. And thanks so much.